Hey traders, thanks for hopping in here today. I'm sorry I don't have live trades from this morning. Last night I was on a red eye from LAS to RDU. Probably got 5 minutes of sleep. The whole flight was just turbulence, 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 turbulence. It felt honestly like a mix between being on the Hollywood Tower of Terror and Rock and Roller Coaster. The whole time it was just so intense, and the worst part about it was I had taken a sleeping pill, and so I felt like I was in third person mode. Like I literally, my soul had escaped from my body, and I was watching myself not be able to sleep. I was so tired, but I could not sleep. It was the worst thing ever. The lesson I'm going to do today is going to be more for beginners. It's going to be on market limit and stop orders. And the reason being is I remember when I first started, and there were certain things that I just could not wrap my head around, and it took me a while. I'm a slow learner, I'll admit that, but perseverance, resilience got me to this point where I understand a lot of this stuff pretty well now. Where market limit and stop orders, I just could not figure out when I first started. I saw the definitions, execute at the best price, or trigger me at this price, and then a market order after that. And I just couldn't wrap my head around it. But we're going to go over it to make sure you guys are up to speed and understand how to place your orders. Market limit and stop orders. What do these mean? Let's first go over market. Market order is a buy or sell order to be executed immediately at current market prices. As long as there are willing sellers and buyers, market orders are filled. Market orders are therefore used when certainty of execution is a priority over price of execution. A market order is the simplest of the order types. A market order, simply put, is just buying or selling at the best available price. So if you're buying a stock on a market order, you're going to be taken out at the ask price of the level 2. So that's why your eyes always want to be on the level 2 on the bid and ask. So if the best bid is at $5 and the best ask is at $5.10, you have a 10-cent spread, and if you do a market order, you're going to be taken out at $5.10, which is on the ask. Now, if you're to sell a stock and the best bid is $5 and the best ask is $5.10, if you're selling at market, you're going to be taken out at $5. And that's the significance of what this sentence means right here that says certainty of execution is a priority of the price of execution. So if you just want to get executed right away, you're going to do a market order. Now, when to use market orders? I use market orders pretty much all the time on stocks that are 5 million in float or less, and that's because I'm waiting for momentum. So my eyes are glued on the level 2 on the times and sales, and if the spread is pretty thin, so it's not like a 10-cent spread, if it's like a 2 or 3 or 4-cent spread, and I see momentum start carrying in, or if I see bids start stacking up on the buy side, I'm going to be very attentive to clicking that buy at market to take out the ask. Because on these low float runners, we're looking for volume, we're looking for momentum to push these sometimes up into a circuit breaker halt. And this has happened to me several times. I'll place limit orders on the bid side to get to executed at a price I want to get executed at, but then the stock starts taking off and it just misses my entry. I don't get filled at all. And that's why a lot of times I'll focus on market orders with these low public float stocks. Market orders are the simplest way to get executed, but you have to be very careful, especially on these low float stocks. If there is a spread on the bid and ask of 20, 30, 40, 50 cents and you do market orders, then right when you get executed, you're going to be automatically down 20, 30, 40, or 50 cents. You got to be smart about it. If you're doing market orders on these low float stocks, you got to understand level 2. Now, on these stocks that have a public float of 10 plus million shares, we're going to want to do limit orders, and that takes us to our next point, limit orders. And simply put, it's a direction given to a broker to buy or sell a security or commodity at a specified price or better. Now, I know some people are going to say that I'm doing this completely wrong. You should never do market orders on lower float stocks, only limits. You should do market orders only on higher float stocks because you don't have a risk of getting slippage or executed at a terrible price. It depends on how you trade, guys. There's so many different ways to trade, but I'm just trying to lay the groundwork for you guys so you understand what market orders, what limit orders, and stop orders are. And then you can figure them out and trade accordingly. I just want to let you know what I like to do, what I prefer to do. If you do not like that, that's fine. We all got to trade our own different ways. There's different type of limit orders. There's buy limit orders, there's sell limit orders, there's stop limit orders. It may sound confusing, but you guys will get it. When you place a buy limit order, that's going to take you out at the price you specify or better. So let's say a stock is at $5 and you place a limit order to buy it at $4.90. So when the stock reaches $4.90, it's going to take you out. It's going to take you out at $4.90 or better, so a better price than that, $4.89, $4.87. A limit order to sell would be, let's say you get entered in at $4.89 or $4.90. Now you place a limit sell at $5 or better. So once the price reaches $5, it's going to take you out at $5 or better, 501, 502, 503. And that's all that limit orders are. They take you out at the specified price or better. Stop orders. A stop order, also referred to as a stop loss order, is an order to buy or sell a stock once the price of the stock reaches that specified price, known as the stop price. When the stop price is reached, a stop order becomes a market order. A buy stop order is entered at a stop price above the current market price. This may sound confusing, guys. It's very simple. This is all it is. It basically combines the limit and the market orders together. So now, let's say you want to get in at the $5 break. What you'll do is put a stop limit buy at $5. So once you put that stop buy at $5, you're not going to get triggered to enter the stock until it reaches $5. So let's say the stock is consolidating at $4.75, $4.80, and then an hour, 2 hours later, it hits $5 and breaks out. Well, now it's triggered your order, and it's going to take you out as a market order. So it triggers your order at $5, and then you get executed at a market order at the best available price. So there can be slippage, especially if there's a breakout at that point. And let's say some shorts have stop losses at 501, 502. So the stock at that point could really break out, and then you're not going to get filled until 505, 506. It's going to take you out at the best available price. This stop order combines the limit and market orders into one. Let's look at the next bullet point. Stop orders generally are a trading or short-term investing strategy. They are useful because they help reduce the pressure of monitoring your trade day to day. The trade is largely set on autopilot. This can be particularly helpful for emotional investors. If you're a very emotional trader, this is going to be pretty helpful too, because then you can walk away. The unfortunate thing is, at least with Thinkorswim in my experience, is if I've been in a stock, I can't place two stop orders. That is, I can't place a stop order below the current price that I'm at and above the current price that I'm at. I would want to do that so that if the stock hits my stop loss order, it'll take me out, or if it reaches my target area to sell, I'll get executed at that as well, and I can just really leave it on autopilot and walk away. You may have a target sell price, but what you'll have to do to minimize risk is, if you're going to be on autopilot, is set a stop loss order and then just walk away. Because remember, gamblers focus on profits and traders focus on risk management. And to focus on the best risk management, you're going to have to place stop orders even if you really think that your target sell price is going to get hit. I'm going to throw this in there for free, guys. Personally, for me and my trading, when I'll use a market order, it'll typically be on lower float and momentum. Now, if I miss that initial momentum on a particular stock, what I'll do is I'll typically use a limit order. So if it breaches the VWAP or any other indicators, the 50-day, 200-day, what I'll do is I'll set a limit order to buy it right around that support. And you can also do limit orders to buy at pre-market support. Just find support with your trend lines or any technical indicators for that matter, and that will be an area to buy at that point and use limit orders. But guys, that's just for me. There's so many orders out there. This is really just entry-level stuff right here. But if you're overwhelmed at all, just don't be discouraged, because you'll get it. You'll figure it out. This is a little bit to wrap your head around, but it'll come to you. And if you have any questions at all, just let me know in the comments section. I'm happy to help you guys out in any way I can. See you tomorrow.